To minimize background noise, please click the mute button until it's your turn to speak to ask questions. You should all have one box on your screens labeled clock. It'll show how much time is remaining. For all senators, the 5-minute clock still applies for your questions. At 30 seconds remaining, you'll hear a bell ring to remind you noise. Please click the mute button until it rings again when your time has expired. You should all have one box on your screens labeled clock. To the next senator, show how much time is remaining. To simplify the speaking order process, Senator Toomey and I have agreed to go by seniority. Seconds remaining for this. You'll hear a bell ring to remind you that 1 year ago we were weeks into this pandemic. Already the United States had the most technology infections in the world. By April, 1 million Americans had gotten the virus. 10 million were out of work. By the end of the year, more than 350,000 had died. We represent just 4% of the world's population, but we were 20% of the world's deaths. A year later, things couldn't look more different. Under President Biden's leadership, we're once again the envy of the world, on track to lead the world in vaccinations. Think about that. After spending a year falling behind other countries with more cases, more deaths, now in a matter of months, things have reversed. We're leading the world again, reminding everyone we can achieve when we unleash American ingenuity and talent. We're showing people what we can do to make all our lives better when we invest in and follow and listen to and follow America's scientists and public health experts. Because of that leadership this summer, we'll again have hugs and barbecues and birthday celebrations. Help wanted signs are going to go up in windows again. Customers will feel safe going back in stores. Families will be back in local restaurants. And as Chair Powell's told us again and again, the best way to get the economy back on track is to get the virus under control. This isn't happening by accident. It's what leadership looks like. It's what a government that's on your side looks like. Last March, as we were staring down those staggering job losses, the Federal Reserve and Congress both sprang into action. We came together bipartisanly to pass the CARES Act. It was a lifeline for so many to help them pay their bills, to keep them in their homes, to keep businesses from going under. And as a side effect of helping everyone else, the bottom did not fall out of the financial system. The stock market, as we know, did more than just fine. That led the last administration and Republicans in Congress to think their job was done. After all, the stock market rebounded, corporate profits were soaring, but for so many Americans, the past year has been the hardest of their lives. More than 540,000 Americans have lost their lives from this virus. That's more than 500,000 families grieving grandparents, mothers, fathers, daughters, brothers. We've lost 9.5 million jobs since last February. Many of those job losses, as we know, have fallen on women. Too many mothers feel like they've lost their livelihoods, lost their support system, lost the ability to have a moment to themselves to breathe. We've missed far too many birthdays and weddings and graduations. Many Americans are about to celebrate their second Passover or their second Easter in a row without being able to attend services or celebrate in person. We've missed hugs with grandparents and family dinners, all the little moments with our loved ones that make our lives full and meaningful. As President Biden said, while it's been different for everyone, we all lost something. Today, help is here, finally. After a year of Americans being told by their government, we can't help you, we can't afford it, you're on your own. After a year of inaction and indifference, the American Rescue Plan will deliver on the hope that Americans voted for. Put shots in people's arms, money in people's pockets, kids back in school. It's the investment we need that will defeat the virus, rescue the economy, begin the work of building a better system for the future. Our witnesses today, Treasury Secretary Yellen, Federal Reserve Chair Powell, play a key role and have played a key role for years, but especially now in our economic recovery. This is Secretary Yellen's first hearing before our committee as head of the Treasury. That makes this the first time in American history a woman's come before this committee as the head of our nation's economic policy. It's about time. Welcome, Secretary Yellen. You and your colleagues at Treasury will have a huge role to play in making the American Rescue Plan a success, making sure that renters and homeowners can stay in their homes, getting funding to our communities to make sure they can help keep small businesses' doors open. I spoke to a Republican mayor in Western Ohio this week who said she's going to use a big part of the dollars that we have sent her to work with local businesses so they can continue to exist and then again grow. You're all charged with expanding the earned income and child tax credit to put money directly in the pockets of workers to help millions of working class and middle class parents keep up with the huge costs of raising a family. And you're responsible for getting direct stimulus checks to the vast majority of Americans. More than 100 million people already have their checks. And just a little more economic security and peace of mind. The Fed can also make sure it uses all of its tools to support a strong economic recovery that reaches all workers in all communities, not just Wall Street. It means we just can't go back to the way things were before the pandemic. For too many Americans, the economy didn't work for them. In fact, hasn't worked for a very long time for them. The gap between workers' wages and corporate profits has soared over the past few decades. Black and brown workers and women, in so many cases, have never had their hard work pay off like it should. And when government is set up to benefit the richest corporations instead of the people who make our economy weak, we get growing inequality, wealth concentrated at the very top, and a shrinking middle class. We're all too familiar with that. The past year, not to mention the past third of the century, makes it obvious. When we funnel money to Wall Street and the largest corporations and the richest tiny sliver of people, it never trickles down to the rest of us. We tried that approach repeatedly. It failed. The American Rescue Plan is the beginning of a new era when we invest directly in the people who make our country work. It means growing an economy where one job is enough to build a middle-class life. It means seizing every opportunity to lead the world in clean energy manufacturing and new clean infrastructure. It means giving people power over their own money and the financial security to weather an emergency. It means building an economy where hard work pays off for everyone. I look forward to hearing from Secretary Yellen and Chair Powell about how we will do that together. Senator Ranking Member Toomey.
Thank you, Mr. Chair, and thank you to Chair Powell and Secretary Yellen for appearing today. A year ago, our economy and markets were roiled by COVID-19 and the government-ordered business shutdowns. We saw extraordinary turmoil in credit markets, and that turmoil threatened the ability of households and businesses, states, and municipalities to obtain the credit that they needed. That kind of turmoil presented, in my view, the very real threat of a full-blown depression that could have taken years to recover from. In response, Congress passed the CARES Act to provide temporary relief to help the country weather a temporary storm. It was really an extraordinary response to an extraordinary situation. And thankfully, it proved remarkably effective, and we are now well on our way to a very strong recovery. The vaccine is being administered at a rate of over 2 million doses a day. States are reopening, and GDP is set to reach pre-pandemic levels at maybe as soon as this month, far earlier than either the CBO or the Fed originally projected. The economy has been in strong recovery mode since last summer when we saw 38% GDP growth in the third quarter, and well before our Democratic colleagues enacted a $2 trillion spending blowout that had little to do with COVID. Congress must not use this pandemic as an excuse to permanently increase the size and role of the federal government. Congress certainly made this clear for the CARES Act emergency lending facilities. These facilities were established to stabilize turbulent credit markets so that households, businesses, states, municipalities could access credit. The intent was clear. The facilities funded by the CARES Act were to be temporary, to provide liquidity, and to cease operations no later than the end of 2020. These facilities were extremely successful in achieving their intended purposes of restoring liquidity in the private capital markets. And in the December COVID relief bill, Congress ensured that these facilities would in fact be wound down by the year end, as Congress had intended and the law required. They cannot be restarted or replicated in the future without congressional approval. In addition to Congress's swift response, the Fed's response last spring was massive and played a crucial role in our ongoing economic recovery. But as is the case with Congress, the Fed also must fight the urge to continue this response beyond its original purpose. Last March, the Fed lowered interest rates to nearly zero and initiated a record expansion of its balance sheet. This accommodation has remained, and by both official forecasts and market expectations, it's going to continue well beyond the point of full recovery. And that raises at least two concerns. The first concern is that the Fed's increased footprint is almost a permanent feature. And if this is the case and there's no eventual reduction in the size of the portfolio, then the Fed's quantitative easing to date would amount to a monetization of government debt. And I certainly hope that that's not the case. The second concern is that such an accommodative stance leaves our economy vulnerable to inflation. The Fed has signaled that its dovish monetary policy is here for a very long time. Its March summary of economic projections doesn't forecast any rate hikes until 2024 at the earliest, and the Fed appears to have no plans in place for reducing its monthly securities purchases. Given the current economic recovery and the recent increases in commodity prices, inflation expectations, and Fed communications, I do worry that the Fed may be behind the curve when inflation inevitably picks up. Final point and a warning. Very, very little of the Democrats' recent $2 trillion so-called American Rescue Plan had anything to do with COVID. It seemed more like a mad dash to claim credit for a recovery that was well underway and authorize as much money as possible to try to fundamentally remake our society to one where the state is at the center of life for many more Americans. It was a partisan, bloated spending bill. It contained stimulus checks for people with six-figure salaries who had no loss of income, expanded welfare benefits that eliminate incentives to work and minimize personal responsibility. There were reparations, as the chairwoman of the Senate Agricultural Committee called a loan forgiveness program that's based entirely on race and ethnicity. There were bailouts for chronically mismanaged states and cities, despite their having record revenue in 2020 and $500 billion in addition that had already been provided by federal aid. And there was a federal plus-up of unemployment insurance that will pay about half of unemployed people more money not to work than they make working. In the long run, those kinds of policies will reduce productivity, diminish economic growth, and that in turn means a lower standard of living for all Americans. And it will exacerbate societal fractures. Fewer people will be paying taxes to support an ever-growing government, and those who do work will increasingly resent those who choose not to and yet enjoy the same or higher standard of living. That's unhealthy for the body politic, for our economy, and for our society writ large. I look forward to the testimony of our witnesses and the question period later. Thank you, Mr. Chairman. Mr. Chairman, I think you're on mute.
Still mute.
Mr. Chairman, if you've got a technical problem here, would you like for me to kick this over to our witnesses and then get back to you? Give me a thumbs up. Okay, then in that case, until we can resolve this technical difficulty, I will recognize our witnesses. I don't have a proper introduction prepared, but if there are ever two witnesses that don't need an introduction, it would be the two folks here. And I think we're leading off with Secretary Yellen. So, Madam Secretary, if you could begin.
Thank you, Senator Toomey. Chairman Brown, Ranking Member Toomey, members of the committee, thank you for inviting me. We're meeting at a hopeful moment for the economy, but still a daunting one. While we're seeing signs of recovery, we should be clear-eyed about the hole we're digging out of.
Figure it out. You want to?
The country is still down nearly 10 million jobs from its pre-pandemic peak. When Congress passed the CARES and Consolidated Appropriations Acts last year, it gave the federal government some powerful tools to address the crisis. But upon taking office, I worried they weren't powerful enough. After all, there were and still are some very deep pockets of pain in the data. 1 in 10 homeowners with a mortgage are behind on their payments, and almost 1 in 5 renters are behind on their rent. There are 22 million people who say they don't have enough food to eat. 1 in 10 adults are hungry in America. I looked at data like these and I worried that the COVID economy was going to keep hurting millions of people now and haunt them long after the health emergency was over. We know that when the foundations of someone's life fall apart, when they lose the roof over their head or the ability to eat dinner every night, the pain can weigh on them for years. Their earnings potential is permanently lowered. I worried about this happening on a mass scale. That's why I advocated very hard for the American Rescue Plan. And it's why my first and most enthusiastic message today is thank you. With the passage of the rescue plan, I'm confident that people will reach the other side of this pandemic with the foundations of their lives intact. And I believe they will be met there by a growing economy. In fact, I think we may see a return to full employment next year. Of course, the speed and strength of our recovery depends in part on how we implement the legislation. Treasury is tasked with much of that work, and there's nothing that I or my team take more seriously. We appreciate your oversight on this matter, and I want to briefly tell you about how we've been working. Since taking office 2 months ago, we've been expediting relief to the areas of greatest need. For example, small businesses, and especially the smallest small businesses, which are disproportionately owned by women and people of color. The pandemic has hit these businesses hard. The Paycheck Protection Program was an early lifeline, but because of issues with the program's design, the first rounds often didn't reach the smallest sole proprietorships. We're addressing that now. We worked with SBA to tweak how the program was implemented. It's allowing the PPP to reach millions more micro businesses and entrepreneurs, especially in rural and low-income areas. We're also building capacity to support these communities over the longer term. Because of the December legislation, Treasury now has $12 billion to inject into community development financial institutions and minority depository institutions. In turn, these CDFIs and MDIs can lend that capital out, helping people buy homes and start businesses in places that the financial services sector traditionally hasn't served well. Then there are the families I spoke about, the ones struggling to keep a roof over their head and food on the table. The American Rescue Plan provides more than $30 billion to help renters and homeowners at risk of losing their homes. And we're making sure that assistance flows as efficiently as possible. For instance, the previous administration put in place rules that required tenants and landlords to provide quite a bit of documentation to get rental assistance, including detailed statements about their income. But some people don't have access to those documents. We're cutting through the red tape for them while still taking reasonable steps to prevent fraud and abuse. And of course, we've been sending direct payments to Americans, a lot of Americans. As of last week, we had issued over 90 million payments. And all this is just a fraction of Treasury's work. There are so many more relief programs, including one that will provide $350 billion in aid to state and local governments. Implementing all of it is more complicated than it sounds, and we're working closely with stakeholders to make sure that these programs are both efficient and effective. Behind these many relief programs, these millions of transactions, are a staff of very dedicated and very tired Treasury and IRS employees. My final word is to them. Thank you. You're putting on a masterclass in how government should work in the furnace of a crisis. I'm grateful to be your colleague. With that, I'm happy to answer any questions you have.
Thank you, Secretary Yellen. Chair Powell, you're recognized for 5 minutes. And thank you, Ranking Member Toomey.
Chairman Brown, Ranking Member Toomey, and other members of the committee, thank you for the opportunity to discuss the measures that we've taken to address the hardship wrought by the pandemic. I'd like to start by noting the upcoming one-year anniversary of the CARES Act. With unanimous approval, Congress provided by far the fastest and largest response to any post-war economic downturn, offering fiscal support for households, businesses, healthcare providers, and state and local governments. This historically important legislation provided critical support in our nation's hour of need. As the virus arrived in force, our immediate challenge was to limit the severity and duration of the fallout to avoid longer-run damage. At the Fed, we also acted with unprecedented speed and force, using the full range of policy tools at our disposal. Today, the situation is much improved. While the economic fallout has been real and widespread, the worst was avoided by swift and vigorous action from Congress and the Federal Reserve, from across government and cities and towns, and from individuals, communities, and the private sector. More people held on to their jobs, more businesses kept their doors open, and more incomes were saved. But the recovery is far from complete. So at the Fed, we will continue to provide the economy the support that it needs for as long as it takes. As we've emphasized throughout the pandemic, the path of the economy continues to depend on the course of the virus. Since January, the number of new cases, hospitalizations, and deaths has fallen, and ongoing vaccinations offer hope for a return to more normal conditions later this year. In the meantime, continued social distancing and mask wearing will help us reach that goal. Indicators of economic activity and employment have turned up recently. Household spending on goods has risen notably so far this year, although spending on services remains low, especially in sectors that typically require in-person gatherings. The housing sector has more than fully recovered from the downturn, while business investment and manufacturing production have also picked up. As with overall economic activity, conditions in the labor market have recently improved. Employment rose by 379,000 in February, as the leisure and hospitality sector recouped about 2/3 of the jobs that it had lost in December and January. The recovery has progressed more quickly than generally expected and looks to be strengthening. This is due in significant part to the unprecedented fiscal and monetary policy actions I mentioned, which provide essential support to households, businesses, and communities. However, the sectors of the economy most adversely affected by the resurgence of the virus and by greater social distancing remain weak, and the unemployment rate, still elevated at 6.2%, underestimates the shortfall, particularly as labor force participation remains notably below pre-pandemic levels. We welcome this progress, but we will not lose sight of the millions of Americans who are still hurting, including lower wage workers in the services sector, African Americans, Hispanics, and other minority groups that have been especially hard hit. The Fed's response has been guided by our mandate to promote maximum employment and price stability for the American people, along with our responsibilities to promote the stability of the financial system. When financial markets came under intense pressure last year, we took broad and forceful actions, deploying both our conventional and emergency lending tools to more directly support the flow of credit. Our actions taken together helped unlock more than $2 trillion in funding to support businesses, large and small, nonprofits, and state and local governments between April and December. This support, in turn, has helped organizations from shuttering and put employers in both a better position to keep workers on and to hire them back as the recovery continues. Our programs served as a backstop to key credit markets and helped restore the flow of credit from private lenders through normal channels. We deployed these lending powers to an unprecedented extent last year. Our emergency lending powers require the approval of the Treasury and are available only in very unusual circumstances. Many of these programs were supported by funding from the CARES Act. Those facilities provided essential support through a very difficult year. They are now closed, and the Fed has returned the large majority of Treasury's CARES Act equity as required by law. Our other emergency lending facilities are following suit imminently, although we recently extended the Paycheck Protection Program lending facility for another quarter to continue to support the PPP. Everything the Fed does is in service to our public mission. We're committed to using our full range of tools to support the economy and to help assure that the recovery from this difficult period will be as robust as possible on behalf of communities, families, and businesses across the country. Thank you. I look forward to your questions.
Thank you, Chair Powell, and thank you, Madam Secretary. Chair Powell, do you think all this fiscal support will help us get to full employment and improve our overall economic and GDP growth?
I think that the fiscal support that Congress has provided since the beginning has been really at the heart of the recovery and deserves much of the credit for the strength of the recovery over the course of the last year. I'm loath to comment on particular fiscal bills, as you know, but I would just say generally this situation really called for a strong fiscal response, and we've certainly had that.
Thank you. Secretary Yellen, how does the American Rescue Plan help women and people of color and the workers who've so often been left behind in our economy?
Well, the rescue plan is very much focused on getting aid in a whole variety of ways to those groups, starting with unemployment insurance, rental assistance for people who are in danger of losing their homes, food assistance, assistance to small businesses, especially in low-income minority communities, just aid to state and local governments, much of which can be directed toward those groups that have been most adversely affected by the pandemic. So there's also child support, an increase in the child tax credit to help families with burdens, household burdens. There's an expansion of the child and dependent care credit that will help women who are at home, have it with family responsibilities, get back to work. So a broad range of features that are directed at those groups.
Thank you, Madam Secretary. And I noticed one of the first things you mentioned is particularly of interest in this committee, and that is the work that a number of my colleagues did to help renters pay their bills and keep roofs over their heads and a roof over their head. I hope you'll continue to work with state, local, and tribal grantees to help this out, to get this help out to renters quickly. Secretary Yellen, do you think people are getting, thank you, do you think getting people vaccinated as fast as possible, as the Biden administration, as the American Rescue Plan are doing, does getting people vaccinated as fast as possible, does that help the economic recovery?
Oh, yes, absolutely. As Chair Powell indicated in his own remarks, ultimately the economic recovery depends on success in getting the pandemic under control, and vaccinations are critical to our ability to accomplish that.
And Chair Powell, as you had said earlier, you obviously agree with Secretary Yellen on that from what you said earlier. Do you think, Chair Powell, do you think direct payments to families help the economic recovery?
Again, I'm reluctant to, these matters are for Congress, not for elected representatives, not for us. Nobody has elected us to make those decisions. I would just rather say at a high level, I think fiscal policy has provided a lot of support, and that's been appropriate.
Secretary Yellen, do you want to expand on that same question briefly, direct payments helping the economic recovery?
Well, I think the direct payments are providing support to families for a wide range of burdens that many have suffered over the last years. There's other support that's clearly targeted, but I think this is helpful, in the spending that it will produce will speed the recovery.
One last question of both of you. Secretary Yellen, do you think that banks buying back their stock helps the economic recovery?
I have been opposed earlier when we were very concerned about the situation that banks would face about stock buybacks, but the financial institutions look healthier now, and I believe they should have some ability to, abiding by the rules to make returns to shareholders.
Okay, my last, even though I said that was the last, my last joint question to both of you, to each of you. What are the lessons learned from the pandemic's impact on the economy that we should use to make the economy and financial system more resilient to the impacts of climate change? Do you want to start, Chair Powell, on that and then close with Secretary Yellen?
So on climate change, I'll just quickly say that, we have a mandate to supervise financial institutions and one to look after financial stability. So we don't have a mandate to do anything in particular regarding climate change. We look at it as only to the extent it's within those particular existing mandates. And as you know, we are in the early stages of trying to understand what the implications are for both for financial stability and for on a microprudential basis for individual financial institutions. How should they think about those risks and ultimately manage them over a longer period of time?
Secretary Yellen?
Yeah, I agree with that. I think it's very important to make sure that financial institutions are resilient to the risks from climate change as well as other risks. And I think it's important for regulators to assess those risks, both to understand them and to help the institutions themselves understand and manage their risks.
Thank you, Madam Secretary. Ranking Member Toomey is recognized.
Thank you, Mr. Chairman. I just have to observe, if you pick up almost any newspaper in towns across Pennsylvania in the last week or so, a prominent story has been recurring all across the state. That is the story of mayors and township commissioners and county commissioners meeting to try to figure out what in the world they're going to do with this mountain of cash that just got dropped on them after having collected all the revenue they expected last year. In some cases, it's 50% of their entire budget. Really, just extraordinary. My question, I'll start with Chairman Powell. And what I'd like to do, Mr. Chairman, is follow up on the conversation we had last week. I want to kind of understand how the recent Fed projections fit together, because in some ways there are some apparent outliers. At least it appears that way to me. What I'm referring to is, the Fed's recent revisions, economic forecasting revisions, have a very significant upward revision in GDP growth. 6.5%, I think, is your real GDP number for this year. Not inconsistent with where a lot of private economists are, but that's a 2.3 percentage point increase. The unemployment rate that you project is only a decline of 0.5%. And the inflation rate, over the course of the full year, you guys are projecting that it will come in lower than it's been for the last 3 months. So on average, for the remainder of the year, you're implicitly projecting inflation to decline. So I think most economic models that would have that big an upward revision in economic growth would have a stronger reduction in unemployment and higher likelihood of inflation. And my concern is, if your models systemically were to understate the progress we're likely to make on employment and understate the risk of inflation, of course, it could lead to accommodative policy that goes too far for too long. So can you walk us through why you have a relatively small improvement in the unemployment rate and a declining inflation despite the strong GDP growth?
I'd be glad to. Let me start by saying that what we publish in the Summary of Economic Projections is just that. It's individual projections that are totaled up and tabulated, really, not it's not something we vote on, but I'll address the medians, which are what we publish. So the reason that unemployment doesn't go down further, given the level of growth, is really just that we see participation expanding on it's a different margin. It's people coming back into the labor market, and that actually holds the unemployment rate up. Is highly desirable outcome. But this was the biggest drop in participation since World War II. That's part of it. There are a bunch of other things that go into it, and of course, there's a good amount of uncertainty around that. On inflation, go ahead.
I'm just, my concern is because obviously private sector economists are aware of the decline in the workforce participation and seem to come to different conclusions. But I understand this is an art, not a science. Let me just, so I'm going to run out of time here, direct my next question to Secretary Yellen. But first, on the topic of IMF SDRs, I do want to thank Senator Kennedy for his leadership on this issue. Madam Secretary, as you know from our conversation, I'm very concerned about the issuance of another $500, $600 billion of SDRs in the name of helping poor countries respond to COVID. SDR allocations are not meant to be a source of foreign aid. That's the realm of Congress to decide whether or not to extend foreign aid. And as you yourself have pointed out, this is an extremely inefficient way to deliver that aid, since the money goes mostly to G20 countries that have no need for this. So I'm just wondering why it is that you seem to have changed your position on the desirability of using SDRs for this purpose. And is this a final decision that's already been made, or is it still in flux?
Well, before committing to it, we will certainly, as the law requires, consult with Congress. I would say that the current crisis has increased the need for global reserves, and that's the IMF's assessment. The global economy suffered a very severe collapse in 2020. It contracted by 3.5%. The emerging market and developing economies face considerable external financing needs, and an SDR allocation will help countries meet this need for reserves without forcing them to tighten fiscal policy, which could lead to further global divergence. Now, this is a joint effort of the global community, and there's broad support for an SDR allocation. It's true that rich countries will get SDR. That's how it works. It's tied to each country's quota in the IMF. But many countries have indicated a willingness and desire to recycle the SDRs they receive, either in the form of loans or grants, to low-income countries. And so that will magnify the impact of the SDR allocation in terms of providing resources to low-income countries.
I see I'm out of time. Thank you, Mr. Chairman.
Thank you, sir. Senator Reid from Rhode Island is recognized.
Thank you very much, Mr. Chairman. Welcome, Madam Secretary. Good to see you.
See you, Tiff.
We are all interested in getting everyone back to work. You've indicated, though, recently that it could be a full year until we reach full employment. In that interim, would you support enhanced unemployment benefits? I think the American Rescue Plan has done a great deal to help the unemployed, but that effort, I think, should continue. Your views, please.
Well, I think, unemployment remains high, and it's important to provide the supplementary relief in the ARP. And that begins to expire, I believe, in the fall, when I believe the economy will be getting back on its feet. People have raised concerns about whether or not this additional aid will deter people from going back to work. That's certainly not an issue when unemployment is as high as it is now. And studies that have been done suggest that people receiving this have been accepting jobs. It hasn't deterred work. But I do think it's appropriate as the economy recovers, and I hope it will by the fall, that should be phased out.
Just a follow-on point. I've noticed coming from Rhode Island in past recoveries, some areas come back much faster for many different reasons. Some are slower. In the last major recession, Rhode Island and Nevada lagged behind significantly. Would it be appropriate for states to qualify for extended benefits if they're over a certain level of unemployment, and even if other states have sort of broken through?
Well, I think, the experience we've had suggests that the time may have come to modernize our unemployment system and to look for ways to tie the generosity of unemployment benefits to local conditions, or to put in place automatic stabilizers that tie to local conditions and to national unemployment rates. So that is an adjustment that would seem sensible to me.
Thank you, Madam Secretary. A further question. Let me thank you because you responded to a letter that Senator Collins and I sent you with regard to the Coronavirus Economic Relief for Transportation Services Act, or the CERTS Act, which actually helps immensely the motor coach, school bus, and passenger vessel companies around the country. Can you give us an idea of when you'll be issuing the guidance for the distribution of these resources? Because these companies are really hurting.
Well, I know they're hurting. They're mainly small businesses. It's a highly complex new grant program, and unfortunately, our need to better understand eligibility and how to get money out to and inform those who are eligible for it. We've been working very hard on this, done a lot over the last couple of months, but we're working very hard to build an online application portal and to write up the standard agreement. So I hope soon we'll be able to get it out. It turns out that there are a large number of companies that are eligible. We expect the demand to be very large relative to the $2 billion in funding that's available, and we'll have to sort through how to allocate it fairly.
Thank you. Chairman Powell, I have just a few seconds left, but we spoke about this previously, bottlenecks in the world economy, and today we have a classic example. The Suez Canal is tied up. But how are you reflecting those bottlenecks in the supply chain in your outcome, if at all, or your projections of economic growth?
Yeah, we have a literal bottleneck in the Suez Canal today.
Yeah, we do.
Yes, we're monitoring all of that, and our staff is trying to model that as well. So we do have some slowdown in production. What's happened is that COVID has changed both demand and supply in some cases, and we're seeing with chips that go into cars now. We're seeing it there. We're seeing it at various places in the economy. The sense of it, though, really is that there'll be a little bit slower growth and maybe some modest upward pressure on prices of those goods. But that should be something that is temporary. You know, bottleneck by definition is temporary as the supply side adjusts.
Thank you very much. Thank you, Mr. Chairman.
Thank you, Senator Reid. Senator Shelby from Alabama is recognized. 5 minutes.
Thank you. Thank you, Mr. Chairman. Secretary Yellen, in 2017, when you were chair of the Federal Reserve, you noted that it was concerning to you that the U.S. debt to GDP ratio was about 75% at that time. Today, the Congressional Budget Office projects debt to reach 102% of GDP at the end of 2021. Is the nation's growing debt something to be concerned about? And if not, why not? Because it seems like we're layering more and more debt because of the crisis and so forth.
So, of course, our finances need to be on a sustainable long-run path, and that's a very critical responsibility for all of us. My views on the amount of fiscal space that the United States has, though, I would say have changed somewhat since 2017 when I said that. And it's partly because the interest rate environment has been so very low. And most economists and observers believe that interest rates have been trending down in developed countries now for several decades, that trend predates the financial crisis and is likely to continue. And what it means is that whereas in 2007, when we had a 35% debt to GDP ratio, now it's closer to 100%. In fact, interest payments on that debt relative to GDP have not gone up at all. And so I think that's a more meaningful metric of the burden of the debt on society and on the federal finances. And so I do believe we have more fiscal space, but it certainly doesn't mean that anything goes. I believe in responding to a crisis with a needed surge of spending that's temporary, that it was fully appropriate not to pay for it under the circumstances, but longer run, we do have to raise revenue to support permanent spending that we want to do.
What long-term issues could come to haunt us dealing with substantial long-term debt to the economy? In other words, it can't be a benefit for the economy except temporarily. What are some of the systemic things that could happen because of too much debt?
Well, if a country has too much debt, it may drive up interest rates. And in the process of doing that, it can crowd out other forms of productive investment in the economy, capital investment, housing, or other interest-sensitive sectors. And that may be a good thing or it may be a bad thing. It depends on what the expenditure is for. If it were, say, for infrastructure spending or for investments in people that had a very high payoff, we might decide that that was a worthwhile trade to make, but it does have the potential to crowd out private spending.
Chairman Powell, I have a question for you, if I could. The 10-year Treasury yield jumped above 1.7% last week, 1.7, which was its highest level more than a year. I think it's dropped a little since then, but the yield curve between the 2-year and the 10-year notes were 160 basis points, the steepest since 2015. What do you attribute to this uptick in yields in recent weeks, and what about the yield curve? Could you get into that just a minute?
Sure. So it seems that rates have responded to news about vaccination and ultimately about growth. So higher growth, higher inflation, lower cases of COVID. So it's, in effect, there's been an underlying sense of an improved economic outlook, and that has to be part of why rates would move back up from the extraordinarily low levels they were at, back up toward levels that we're more likely to see. And that has been an orderly process. I would be concerned if it were not an orderly process, or if conditions were to tighten to the point where they might threaten, our recovery.
Mr. Chairman, we're all concerned about inflation, price stability, and that's one of your mandates at the Federal Reserve. In the event that inflation does rise precipitously and becomes an issue, we hope not, but it could, what tools would the Federal Reserve utilize or have left to maintain or work toward price stability?
Our most fundamental and well understood tools really are for that purpose, for the purpose of guiding inflation. That's really our tools that create accommodative or less accommodative monetary policy. So that's interest rates, and it's also asset purchases. So let me just say, we don't expect the kind of inflation that you talked about, but we have those tools. And if we were to face inflation that moved up and that threatened to de-anchor inflation expectations materially above 2%, then we would have those tools and we would use them in a way to guide inflation back to 2%.
What do you believe is going to be the
Senator
growth
Shelby,
rate?
wrap up if you can, Senator Shelby.
Okay, my last question. What do you think will be the growth rate of the economy, real growth, in the next 9 months?
Well, I don't have a personal forecast I would disclose, though, but I will just point to the median of FOMC participants for this year was 6.5%, I believe. And that's very much, as Senator Toomey, I think, mentioned, that's very much in line with public forecasters. It is going to be a very, very strong year in the most likely case. There, of course, are risks to the upside and downside, but it should be a very strong year from a growth standpoint.
Thank you, Mr. Chairman.
Thanks, Senator Shelby. Senator Tester from Montana is recognized for 5 minutes.
Yeah, thank you, Mr. Chairman. And I want to thank both Secretary Yellen and Chairman Powell for being here today. Chairman Powell, thank you for your continued service. And Secretary Yellen, it's good to see you back in the game again.
Thank you.
I'm going to start with Chairman Powell. Following the passage of the American Rescue Plan, the Federal Reserve upgraded your economic projections. The FOMC estimated last week GDP will rebound and unemployment rates decrease more quickly. But as you highlighted already today, we still have a ways to go. Over the past year, I've shared your concerns of undershooting the economic recovery. And there are still many small businesses, workers, and families in Montana and across this country that are struggling because of this pandemic and the economic crisis it has created. How concerned are you about inflation once the economy gets on the plus side?
Well, let me say, we take the 2% inflation target very, very seriously. It's half of our mandate. So we're strongly committed to inflation at 2% over time. To us, that means inflation expectations need to be anchored at 2%, and that means that inflation has to average 2% over time. So it's absolutely fundamental that we achieve that. In the near term, we do expect, as many forecasters do, that there will be some upward pressure on prices, and also there'll be a technical thing, a base effects, as the very low readings from April and March of last year drop out of the 12-year calculation. We don't expect that that upward pressure will produce substantially higher prices, or that the effects will be persistent. We expect that they'll be transitory or temporary. If it turns out that we do see substantially higher inflation, that would risk persistent inflation materially above our goal, then of course we would use our tools to bring inflation back down to 2%.
And from what you just said, then you anticipate there could be some upward pressure, but long term you don't see this as being an issue.
Long term, we think that the inflation dynamics that we've seen around the world for a quarter of a century are essentially intact. And we've got a world that's short of demand with very low inflation. The U.S. has had low inflation for some time, and we think those dynamics haven't gone away overnight and won't.
Thank you, Chairman Powell. Secretary Yellen, I see you're working from your home. There's a bunch of decisions that you have to make about how this money is going to go out and what it can be used for, and the kind of flexibility that's out there. I'm talking about from the American Rescue Plan. Different localities face different challenges, but the fact is that there was a concerted effort to make sure that we get some money to municipalities without the state skimming off any money, and not only municipalities that are large, but municipalities of all sizes. The question is are you committed to making sure that these funds make it to the smallest of towns that haven't received any assistance yet, without the state skimming off any money off the top, or adding additional restrictions that weren't included in the legislation or Treasury's guidance?
Well, we're committed to following the instructions that Congress gave us, and I would agree that was Congress's intention, where we have about 60 days to write the guidance on the use of those state and local funds. We're consulting broadly. Congress intended for there to be a lot of flexibility in how states and localities can use those funds, and we will certainly try to make sure that they're distributed as Congress intended and that the flexibility is there. Although we also want to make sure that that we have requirements to make sure the money is used responsibly in accordance with Congress's direction.
I appreciate that. When do you say you got 60 days to write up the guidance? Could you give me a ballpark figure? Will it take the full 60 days for the guidance for municipalities, or do you intend to get it out sooner?
We're working as hard as we possibly can on this. There are a host of issues about how to interpret the requirements of this statute. I don't want to promise that it will take less than 60 days, but we're going to try to get this done as soon as we possibly can.
I appreciate that, and I appreciate your hard work on this. I get questions all the time about the flexibility of how these monies can be used. By the way, the municipalities or counties in Montana are very thankful for these dollars. They've been running on shoestring budgets forever, and this is the first time they're going to be able to make some real improvements in their counties and municipalities. And plus being able to pay for police officers and fire departments and make sure the garbage gets picked up. So thank you very much. I appreciate both of you, and we look forward to visiting on down the line. Thank you, Mr. Chairman.
Thanks, Senator Tester. Senator Crapo from Idaho is recognized for 5 minutes.
Thank you, Mr. Chairman. And Secretary Yellen, I want to talk with you about another guidance issue that we need to focus on in the American Recovery Act. In the Act, there is a restriction on the use of funds under the State Fiscal Recovery Fund that was included that would prohibit states from using funds to, and this is a direct quote, either directly or indirectly offset a reduction in the net tax revenue of such state or territory resulting from a change in law, regulation, or administrative interpretation during the covered period that reduces any tax by providing a reduction in a rate, a rebate, a deduction, a credit, or otherwise, or delays the imposition of any tax or tax increase. Now, as you know very well, this has raised many questions and concerns. 11 of my Republican colleagues and I introduced the State Fiscal Flexibility Act last week to simply remove this troubling restriction from the law. 21 state attorneys general wrote you asking for a clarification on this issue, and a lawsuit was filed by the Ohio Attorney General. This is an issue that needs immediate clarity. And I'm aware of the letter that you responded to the attorneys general with, in which you said that you will provide guidance before the states must submit a certification under 602D1. But that doesn't really tell us how soon this guidance is going to come out. It seems to me that states are hamstrung right now. They can't do anything until you give them the guidance. Can you give us some clarity on how soon this guidance will come out?
Well, we have a 60-day period to complete the work to get the money to distribute to the state and local governments. And there are a host of thorny questions that we have to work through that connect with the issue that you just mentioned. And we simply are going to have to try to craft guidance in that period of time. We're working on it 24/7 to get it out as rapidly as we possibly can.
Well, thank you, and I appreciate that. I'm going to encourage you to do everything you can in developing this guidance to answer those thorny questions in a way that gives maximum flexibility to the states and local communities. Again, in the letter you wrote to the attorneys general, you seemed to be moving in that direction. You stated that nothing in the act prevents the states from enacting a broad variety of tax cuts. It just cannot use the revenue from the act as an offset for those tax cuts.
That's correct.
And I really appreciate that perspective. As I'm sure you're aware, that still leaves the question as to what is offsetting. How do you intend to approach the question of what is directly or indirectly offsetting a tax cut?
Well, when I said that we have thorny questions to work through, you've just indicated why we do. We will have to define what it means to use money from this act as an offset for tax cuts. And given the fungibility of money, it's a hard question to answer, but that's what we're required to do, and we will do our best to offer guidance on it.
Well, you just hit the nail on the head when you referenced the fungibility of money. And so, I want to encourage you to be very restrictive in terms of the application of this prohibition and give the maximum flexibility to states and local communities as they administer these funds. I just want to ask you an example question. I want to keep pushing on this issue with you.
All right.
And I realize you may not be able to answer this any more specifically than you've been able to give specifics so far, but I'm just going to give a hypothetical. What if a state decides that, as with the Federal Act's waiver of federal taxation on a certain amount of unemployment compensation, the state would like to also waive a portion of its tax on those same unemployment compensation dollars, would that be a penalty that the state would have to pay for if it did that?
So we've been asked this question by a number of states, and it's one we're going to have to consider and work through whether conforming changes that states make, for example, with respect to unemployment insurance, whether or not that would qualify as a tax cut or be exempt, and we're examining that question carefully.
Well, thank you. Again, I'm just going to encourage you again to give the states the maximum flexibility they can. They are hamstrung. And the last thing we should do is put states in a predicament where they could lose the funding that was authorized by Congress to help them just because they want to manage their fiscal policy in a way that might include some reduction of tax revenue. Thank you. Thank you.
Thank you, Senator Crapo. Senator Menendez from New Jersey is recognized for 5 minutes.
Thank you, Mr. Chairman. The Paycheck Protection Program has delivered over $718 billion in critical relief to small businesses. It's set to expire exactly 1 week from today. Secretary Yellen and Chairman Powell, is the economy at a place where Congress can safely end PPP relief to small businesses?
So, of course, the economy is not at a place where small businesses that have been affected are able to thrive. I'm not sure how much money remains in the program, but there is some, and I would be supportive of an extension.
Chairman Powell?
I would defer to the Secretary on that question. Thanks.
Well, in February, 3 out of every 10 small businesses said they would likely not survive 2021 without additional government assistance. Now, fortunately, the American Rescue Plan included $7.2 billion for PPP loans and second draw PPP loans. But if Congress doesn't reauthorize the program in the next 7 days, that money will never reach struggling small businesses. So I think it would be reckless and cruel to let the program expire when there are still about $50 billion of desperately needed PPP funding remaining and businesses waiting for relief. So I'm glad to hear that you agree that it should be extended. The Center on Budget and Policy Priorities estimates that as of March 1st, there were 13.5 million adults behind on rent and an additional 10.3 million adults behind on their mortgage payments. As we've seen throughout this crisis, the brunt of that pain is being felt in minority communities. 33% of Black renters, 20% of Latino renters, 16% of Asian renters say that they were behind on their rent compared to 13% of white renters. The American Rescue Plan included $25 billion in rental assistance, nearly $10 billion in homeowner assistance, and one of my major priorities, $100 million in housing counseling to help renters and homeowners avoid foreclosure or eviction. Now, Chairman Powell, you recently said that there is a real crisis, that when there is a real crisis, quote, don't stop until the job is done, close quote. Would you say that current mortgage and rental payment delinquency rates, particularly among minority families, indicates that the job is done?
Well, I would say actually the level of distress was very, very high and has recently been coming down a bit, but it's still quite material. And so that crisis is certainly not over.
So is providing housing support both through rental and mortgage relief what you meant when you said, quote, Congress, of course, has come with quite a strong fiscal policy? Would this be part of that fiscal policy?
I meant that statement as a general statement that the fiscal response overall has been remarkable, frankly.
So, but a fiscal response that leaves millions of people out of their homes, whether they be as renters or homeowners, isn't going to be a fiscal response that's going to provide us long-lasting benefits. Is that fair to say?
I would say it is.
Okay. Let me ask you this. With 402 economists, the Board of Governors employs far more PhD economists in the largest university department. However, only 24% of the board's economists are minorities. Things are slightly better at Treasury. Only 30% of the 148 economists employed at the Department of Treasury are minorities. Secretary Yellen, you previously stated that if economists are mainly of one gender or race, they are likely to miss things that matter. Chairman Powell, do you agree with Secretary Yellen's statement?
I very strongly agree with it.
I'm sorry, please finish.
I'm just going to say we clearly benefit from diverse perspectives. We see that.
So let me ask you both then, considering the current makeup of Treasury and Federal Reserve economists, are either of you concerned they might be missing things that matter?
Yes, and I'm very focused on pursuing diversity and hiring to make sure that we do have diversity in the economics team at Treasury and throughout Treasury. It's a very high priority.
And at the Federal Reserve?
So this is something very, very high priority, something we've worked hard at for some time, and we're not at all satisfied with where we are. We do a lot of outreach to historically Black colleges and universities, as well as Hispanic serving institutions. I met with a group with a class actually of minority students from historically Black college just last week. Spent an hour with them. But more than that, we have a systematic program to encourage more minority kids to study economics, and if they do study economics, to think about the Fed and that sort of thing. But there's a lot of work to be done there. It's a challenge we're very focused on.
Well, I'd be happy to work with both of you in providing individuals, I think, who presently could meet the challenge. Thank you, Mr. Chairman.
Thank you, Senator Menendez. Senator Rounds from South Dakota is recognized for 5 minutes.
Thank you, Mr. Chairman. And thank you to both of our panelists for your service to our country. Secretary Yellen, I'd like to begin with you. I'd like to direct this. As I'm sure you're aware, the IRS is facing a severe backlog when it comes to processing tax returns. These problems, like the 2.4 million backlog in untouched tax returns and severe staffing issues at the IRS, were laid out at a recent oversight hearing conducted by the House Ways and Means Committee. The tax processing issues at the IRS are troublesome enough, but what I found even more disturbing is that there was no plan on the part of the IRS for how to fix the problem. My question, I guess, is what can be done to get the IRS to work through the backlog and to return a more normal state of operations? And I guess the reason why, in particular, I bring it up today is we're thinking about the fact that there are 2019 tax returns that, since they've not been completed yet or been processed, it's going to make it a lot more difficult for the 2020 tax returns to be filed, and you're going to have some taxpayers that may very well end up in that position of kind of a death spiral of penalties being imposed on them simply because they can't get responses back from the IRS. Number one, have you had a discussion about what the steps should be to begin fixing the issue? And then second of all, will the IRS hold taxpayers that find themselves in this position harmless?
I've met with the IRS commissioner and discussed a range of questions, including IRS's ability to distribute economic impact payments and the child tax credits on a periodic basis. I haven't had a detailed discussion with the IRS commissioner about the issue that you raised, but in general, the IRS needs more funding to be able to work appropriately to put in place the technology it needs to collect taxes. We know that there's a huge tax gap. It's estimated at something like $7.5 trillion over the next decade. And more generally, I think IRS needs funding to be able to appropriately manage the burdens it has, including, providing support to taxpayers who call. A shortage of personnel makes it a frustrating matter to try to call to get advice from over the telephone.
And it's not my point to be argumentative with you, Madam Secretary. I just simply point out that you've now got $1.9 trillion that have been allocated, specifically some of it for pandemic relief. And the IRS suffered too, because during the pandemic, they had a very difficult time in getting their folks to be able to work, and that's very understandable. But I do think that it's not unreasonable for us to ask for a plan to try to take care of that backlog. And I would simply ask for your commitment that you would go back and expect them to respond to you and then to us with a plan that's appropriate to get that backlog resolved as quickly as possible.
I'm certainly willing to do that and to work with you in your office and let you know what the plan is.
Thank you, Madam Chair, or Madam Secretary. Also, and I'll just share with you, as we've just begun to highlight, you have a lot of challenges ahead of you, but one of the biggest tasks that the Treasury will be obligated to complete in the near term, outside of pandemic relief, is the implementation of the Illicit Cash Act. I partnered with Senator Warner on this, and we were able to get it into the National Defense Authorization Act. And so it's there, it's been signed into law. Given everything on your to-do list, and I think I've just added a few more to that, can you lay out a rough game plan for how you would envision implementing the Illicit Cash Act?
FinCEN and Treasury more broadly have been very focused on implementing the provisions of the NDAA. It's a very high priority project for us, and we're already very hard at work and hiring people in order to be able to complete that work in a timely way.
Thank you, Madam Chair. I had a question for the chairman, but I will put it in as a question for the record. I see that my time has expired. Thank you, Mr. Chairman.
Thank you, Senator Rounds. Senator Warren from Massachusetts is recognized for 5 minutes.
Thank you, Mr. Chairman. So after the 2008 financial crisis, Congress passed the Dodd-Frank Act to put more cops on the beat and prevent Wall Street from wrecking our economy again. One of the protections that Dodd-Frank put in place was to automatically create a special designation for the too big to fail banks. At the time, those with assets of $50 billion or more. So they received stronger oversight by the Federal Reserve. Chair Powell, why did Congress think it was a good idea to put stronger oversight in place for banks above a certain size?
I think it was a wise decision. It was, particularly for the very largest institutions, it was clear at the time that we needed to raise expectations across a very broad range of measures, including particularly capital, liquidity, risk management.
Okay, and we needed better supervision to do that, I take it.
I would agree.
But it isn't just banks that pose a risk to the economy. In 2008, 2 investment companies, Bear Stearns and Lehman Brothers, failed, triggering the 2008 crash. So when Congress passed Dodd-Frank, they created the Financial Stability Oversight Council, or FSOC, and gave it the power to designate non-bank firms as too big to fail, or in the terms of the statute, to designate them as systemically important, which means they get the same stronger oversight as the too big to fail banks. Is that right, Chair Powell?
Yes, it is.
Okay, so let's look at an example of how that's working today. BlackRock is the world's largest asset management firm, overseeing nearly $9 trillion in assets. That's more than double where it was 10 years ago. It also holds a stake in just about every company listed on the S&P 500. To put that in perspective, BlackRock manages more assets than the entire GDP of Japan, or Germany, or Great Britain, or any other nation in the world except the United States and China. And it's not just size. BlackRock also runs a technology platform that currently houses at least 10% of all the stocks and bonds around the world. So, Secretary Yellen, just hypothetically, if a $9 trillion investment company failed, would that likely have a significant impact on our economy?
Well, Senator Warren, I believe it's important to look very carefully at the risk posed by asset management industry, including BlackRock and other firms. And the FSOC began to do that, I believe, in 2016 and 2017. But the risks it focused on were ones having to do with open-end mutual funds that can experience massive withdrawals and be forced to sell off assets that could create fire sales.
Right.
That is actually a risk that we saw materialize last spring in March. And I think that with respect to asset management, rather than focus on designation of companies, I think it's important to focus on an activity like that and to consider what the appropriate restrictions are. It's not obvious to me that designation is the correct tool to address.
Well, now, wait just a minute. Designation is what gives the Fed its increased oversight power. Is that correct? Is that correct?
Yes.
And is BlackRock currently designated so that it receives that increased oversight?
It isn't designated, but I think it's important to understand.
So that means it is not receiving the increased oversight from the Fed. So my question is, are you currently looking at designation for companies like BlackRock, $9 trillion companies like this?
Well, as I said, FSOC has looked at this issue in the past.
I understand they've done it in the past. I'm not asking about what the last Secretary of the Treasury did. You are the head of FSOC now. And the question I'm asking is whether or not FSOC is considering and looking at designation for these large financial institutions.
Well, I think it's appropriate to designate institutions whose failure would pose a material risk to U.S. financial
stability. And that's why I started my question with, does potentially a $9 trillion investment company pose some risk to the American economy if it should fail?
Well, one needs to analyze what the risk is. An asset management company is very different than
how do you analyze what the risk is if you're not actually doing the investigation through FSOC?
Well, FSOC has undertaken such work in the past. And as I said, when it looked at asset managers, it issued a report outlining what it saw as some of the most significant risks
from those industries. So I appreciate that they've done this in the past. Are you continuing that investigation now?
Well, I'm just beginning a work program with FSOC, and certainly risks from asset management will be on the list.
I understand that when the stock market is going up, it is easy to ignore risks that can be building up in the system. That was the mindset of the regulators that led up to the 2008 crash, and that is how taxpayers ended up on the hook for a $700 billion bailout of the giant banks. When the party is going strong, it's the job of the regulators to take away the punch bowl. My view on this is that Congress gave you the tools to monitor these companies for risk, and it is important to use them. Mr. Chairman, thank you for allowing me to go a few minutes over with another brief question. Secretary Yellen, I am grateful to you and President Biden for your leadership in enacting the American Rescue Plan. A critical part of this bill is the $350 billion assistance for state and local governments. Some of our hardest hit communities in Massachusetts are smaller cities under 50,000 in population, places like Chelsea and Everett and North Adams. So I want to ask you, excuse me, about how they get help from this bill. Secretary Yellen, in general communities with populations under $50,000 receive some direct federal funding as a result of the American Rescue Plan, but they don't receive as much direct help as bigger cities. Is that correct?
Well, I believe there's a formula that determines how much they receive, and it's paid to them through states. I believe that's
good. That's where I want to go, because direct funding is not the only money coming into state and local government. In addition, State governments also receive a separate pot of money that was flexibly designed
That's
to
right.
help our hardest hit communities.
Sure.
And specifically, the statute says that state funding can be used to respond to public health emergency with respect to the coronavirus disease or its negative economic impacts, including assistance to households, small businesses, and nonprofits, or aids to impacted communities. Is that correct, Madam Secretary?
Yes, it is correct.
Good. And in Massachusetts, it looks like there will be about $4.5 billion going to the state government. So, Secretary Yellen, just to be clear, this statutory language provides our governor with the flexibility to use state funding to provide extra help to address negative economic impacts in smaller communities that did not qualify for larger pots of direct funding. Is that right?
That is my understanding, but we will put out guidance and work through all of the legalities. But I believe that what you have said is correct. I want to be very careful about the legalities, but I believe that what you said is correct.
Senator's time has expired.
I appreciate that. Thank you very much. Thank you, Mr.
Senator
Chairman.
Tillett from North Carolina is recognized.
Thank you, Mr. Chairman, and Chair Powell, Secretary Yellen, thank you for being here today. Secretary Yellen, I have a quick question. During your confirmation process, you said that a global minimum tax could stop the destructive global race to the bottom on corporate taxation and help discourage harmful profit shifting. You went on to say that it's necessary for U.S. companies to be globally competitive, and that's why the OECD negotiations are so important. But I'm trying to understand, having been a state legislator and Speaker of the House, I'm trying to understand how this is different from federalism and the states trying to be competitive. When I became Speaker of the House, we had the highest corporate tax rate of any state that had a corporate tax rate. Now we have one of the lower ones. We were also in the fourth quartile for economic performance and for corporate job creation. Now we're in the top quartile. So why would any country like a Vietnam or Thailand or any developing nation buy into the idea that they should have a minimum corporate tax rate? Why wouldn't we expect, just as an extension, why wouldn't we expect a flow into those jurisdictions that would have a lower corporate tax rate at the expense of the United States?
Well, we believe that the OECD negotiations can be productive in creating a regime in which there is a minimum corporate tax rate, and that it's a way of stopping destructive race to the bottom in terms of countries competing for business based on their corporate tax rates. And this is something we're committed to working to try to accomplish internationally.
So do you believe that the lowering of the corporate tax rate here in the United States didn't have a material impact on economic expansion in the United States?
I don't think it had a very substantial impact on investment spending in the United States. People are still studying that, but it does, I think it is necessary for U.S. firms to be competitive. President Biden has suggested raising the corporate tax rate back to 28%. We, at this point, collect only a tiny amount of revenue through the corporate tax, less than 1% of GDP. And I believe it is appropriate to raise the tax rate, but we need to worry about the competitiveness of American firms, and doing that in the context of a global agreement.
I've got one other question. So in your opinion, the increase of the corporate tax rate up to 28% will not cause any significant competitive disadvantage for the United States for corporate expansion?
Well, I think it would be important to make sure that it's done in the context of a global agreement.
Okay. Last month, you gave public support for the IMF's proposal to issue a new allocation of special drawing rights. Several proposals have been put forth. I think just yesterday, the IMF announced that they're seeking $650 billion. I believe that there was a House proposal that was looking at $3 trillion. I know proponents of the SDR say that this has no budgetary impact, but I don't think that tells the whole story. Isn't it the case that the U.S. Treasury has to borrow the dollars it gives out to the IMF when the SDR exchange is made?
Yes, it does. If we provide the dollars, that's true. But we also earn interest to the extent that we hold SDR above our allocation.
But if you do the SDR allocations, you're either going to issue T-notes or T-bonds, right? And to finance this, to finance increase in the SDR obligation. Is that correct?
So I believe that CBO scores this as not having a cost, a net cost.
They say it has no budgetary cost. So is the U.S. really misrepresenting the situation with respect to longer-term taxpayer obligations?
I don't think so, because there will be interest that are earned on the SDRs that offset the payment of interest to issue, say, T-bills. And it's not only the United States that will likely provide hard currency in exchange for SDR. There are other countries that also will take part in that.
Well, Mr. Chairman, my time has expired. I'm going to keep to the 5 minutes. Chair Powell, I had a question on asset bubbles and your insights into maybe global asset bubbles, but that's something I'll just submit for the record. Thank you both for being here.
Thank you, Senator Tillis. Senator Van Hollen of Maryland is recognized for 5 minutes. You're mute, Chris.
Secretary Yellen.
There you go.
Can you hear me okay?
Yep.
All right. Well, thank you, Chairman Brown. I want to thank Secretary Yellen and Chairman Powell for your testimony. Secretary Yellen, I think that the action you took with respect to SDR is in our national interest, and I appreciate you moving forward on that.
Thank you.
I did want to ask you a question about long-term unemployment. I was heartened by your testimony this morning that you hope and anticipate that because of the passage of the American Rescue Plan and other measures that have been taken, that we may get back to full employment by the summer of next year. I remain very concerned about the long-term unemployed. Even before the pandemic hit, we had more than 1 million Americans were long-term unemployed, meaning they were looking for work for more than 6 months and couldn't find anything. That number is currently 4 million. I do expect that with the natural improvement of the economy, that number will come down. But I also think that if we don't take deliberate measures to help bring the long-term unemployed back into the economy, that we're going to be leaving them behind. I did have a conversation with Chairman Powell about this in our last hearing. He agreed that deliberate, targeted measures were necessary beyond just the natural lift in the economy that we hope we'll see as a result of measures taken. Do you agree with that assessment?
Well, I am worried about the long-term unemployed, and think we should be focusing importantly on what we need to do to make sure that they're not permanently scarred. Yes.
And would you agree, though, that beyond measures we take to, fiscal policies and other policies that we take to improve the economy, that in order to address the needs of the long-term unemployed, we're going to have to be more deliberate and have policies targeted to accomplish that?
We may very well. And I'm not sure, Senator, exactly what you have in mind, but policies that focus on training, workforce development may be appropriate as the economy recovers.
Right, I appreciate that. Well, Senator Wyden and Senator Baldwin and I have proposed different forms of long-term unemployment elimination bills. They do include a workforce training component, but they also include some level of subsidized employment for 1 or 2 years combined with those wraparound services in order to make sure that we address this chronic problem. As you've said before, the longer somebody's out of work, the harder it becomes for them to find work. And when they do get it, they may be stuck with lower wages for the rest of their working life. So we hope to deal with this in the next piece of legislation on infrastructure improvement and other challenges. Let me ask you about the IRS because we've seen chronic underfunding of the IRS since really 2011. And as a result, it's hard for Americans to get their phone calls returned. It's harder for the IRS to process things like payment. Right now, a lot of people are still waiting for their refunds from last year's tax season. In addition to that, the estimate is that as a result of the lack of enforcement ability, about $570 billion in taxes that were owed last year did not get paid. 70% of that coming from the top 1% of Americans. So for all of these reasons, you agree that we need to better resource the IRS, both to improve customer service and to make sure that tax cheats don't get away with not paying their fair share.
I absolutely agree. The tax gap is huge, and I think we'd have a fairer tax system and collect more tax revenue without the need to raise rates if we resource the IRS properly to be able to address this issue.
I look forward to working with you on that. We were able to provide $1 billion as part of the American Rescue Plan, but
yes,
more is needed. And with my other hat, I chair the subcommittee on financial services and general government appropriations, and we're going to be asking for your help as we look at this issue. Thank you, Mr. Chairman.
Look forward to working with you on it.
Thank you, Senator Van Hollen. Senator Kennedy is recognized from Louisiana for 5 minutes.
Can you hear me okay?
Yep.
Chairman Powell, I want to start unusually for me with a statement as opposed to a question. I have been very supportive of you and the Federal Reserve and its independence. That was my position with the Trump administration. It will be my position for what it's worth with the Biden administration. And in fact, I have said both publicly and privately, Mr. Chairman, that the single most important thing that was done to save the world economy, not the American economy alone, the world economy from melting down at the during the shutdown last March, was your decision to implement a foreign currency swap line when the whole world was not looking for treasuries, they were looking for dollars. There's an effort going on worldwide to blur the line between government and politics on the one hand, and central banks and their independence on the other. I see every day central banks getting more and more involved in fiscal policy and lobbying legislators with respect to the adoption of fiscal policy. I've noticed that the Bank of England has announced in its QE program that it is going to stop purchasing corporate bonds from companies that it thinks has too big of a carbon footprint. I've noticed recently that the Reserve Bank of New Zealand has decided it's going to start in its policy making, its monetary policy, taking account of housing prices. Now, this is where I'm headed, Mr. Chairman. The Federal Reserve needs to maintain its independence in America. Your credibility depends on political independence. I give you Turkey if you don't believe me. And besides that, the Federal Reserve and the good people in it are unelected. They don't have democratic accountability. And my concluding point, and I'm just going to ask you to respond briefly. Some people are going to beat on you, Mr. Chairman, like you stole Christmas, to get involved in social policy in the guise of economic policy. And for the long-term health of the Federal Reserve, you need to resist that.
Thank you, Senator. So I do think Fed independence, and thank you for your strong support on that. I do think that Fed independence is an institutional arrangement that has served the public well over time. And I am strongly committed to continuing it. I also would agree that getting off of our home base and straying from our mandate is something that will put independence at risk over the long term, because we have this precious independence because we have a limited mandate and we stick to it. If we're going to be playing on every issue, then the case for our independence weakens. We should have as little. There should be very few examples of independent agencies that aren't part of the administration.
And you're one of them, Mr. Chairman. And I apologize for cutting you off, but I want to stay within my time, and I need to ask Secretary Yellen a question. Secretary Yellen, the Biden administration's plan, and it is your plan, to require the IMF to issue $1 trillion of these SDRs, new SDRs, is going to cost the American taxpayer about $180 billion. Now, your reason for doing that is a good reason. You say you want to help poor countries. But you and I both know that only about 10% of that money is going to go to poor countries. It's not going to help poor countries. It's going to help if they cash in their SDRs. It's going to help China. It's going to help Russia. It's going to help Venezuela. And besides that, under your plan, you're intentionally splitting the plan into two tranches of $500 billion each to avoid having to come before Congress. And I don't understand why it is efficient to charge the American taxpayer $180 billion, all of which we have to borrow, and you say you're doing it to help poor countries, and only 10% is going to poor countries, and even more is going to Russia and to China.
I'm sorry, it's not going to cost the taxpayer $180 billion.
Sure it is. You're going to have to borrow the money. You don't have the money sitting in a checking account.
The IMF.
They're going to redeem those SDRs, not just the poor countries, but China.
There are many countries that can provide hard currencies in return for SDRs, including the United States. If the United States does agree to provide SDRs, it will have to issue treasury bills or debt to do it, but it will also.
I rest my case.
I'm sorry, but it will also earn interest on any amounts that it converts on behalf of other countries, and it will be essentially a wash.
But the money will never be paid
back. And it will pay. It does. There is no money to be paid back.
Sure.
It doesn't matter. The interest that we earn on any excess SDR holdings offsets the cost of issuing treasuries, and it's essentially a wash, and it is not costly.
I disagree with you, Madam Secretary. I think I'm no disrespect, but I think you're wrong. I think we're going to have to borrow all $180 billion of this.
I don't know where you got a number like that from.
Well, when China comes to redeem its SDRs and says we want dollars, where do you think we're going to get the money? We're going to borrow it. I've gone over. I'm sorry, Mr. Chairman, but this is an important issue. I'll call you, Madam Secretary.
Okay, I'd be glad to talk about it offline.
Thank you. Thank you for your time.
Thank you, Senator Kennedy. Senator Cortez Masto from Nevada is recognized for 5 minutes.
Thank you. Secretary Yellen, Chairman Powell, welcome back to the committee. Let me start by expressing my appreciation to the staffs at your agency who are charged with implementing the laws that we have passed. I know that the staff at the Internal Revenue Service, Treasury Department, and the Federal Reserve have worked long hours to implement these laws. So let me just say, on behalf of Nevada, on behalf of the American people, I so appreciate the work that your staff have done to deliver financial assistance to Americans. So thank you for that. Let me start, Chairman Powell, with you. It's a conversation we always have around our hospitality and tourism industry, as you know, that's been so hard hit. Can you talk to me about what you're seeing with respect to those economies and the recovery? I think you've said that about 2/3 of the tourism and hospitality jobs lost in March 2020 are back. So can you talk a little bit more what you're seeing as a result of the relief that we have passed here in Congress and the impact it is now having on hospitality and tourism?
Sure, I'd be glad to. So actually, it's just 2/3 of the jobs that were lost during the winter COVID spike came back. The hospitality industry is still down. Travel and hospitality is still down several million jobs, and I'm sure you're seeing that at home. We're beginning to see airline travel. We're beginning to see people going to restaurants and hotels, and all of those things are just beginning to pick up. And all of that, of course, is motivated by declining COVID cases and increasing vaccinations. And if we can just stick to social distancing and mask wearing, if I can put that commercial in again, it'll enable us really to get this done and get the economy reopened. And all of these small businesses that are hurting so much can get the relief that they need. And it's right there to be done if we can follow through on this in coming months.
I'm curious, do you see any regional variations in jobs returning in this industry?
It's very much unemployment generally is very much concentrated in these states like yours and others that have high tourism and travel and entertainment components. Those are the ones that are suffering. I don't know. As between individual states within that group, I don't know about. I couldn't say much sitting here today about how much variation there is.
No, thank you. And thank you for your work and always speaking up and out about the need to address the concerns that we see with the hospitality and travel industry that's been so hard hit because of this pandemic. Secretary Yellen, as part of the American Rescue Plan, we also included $10 billion in assistance for homeowners. And so can I ask, what is your timeline for getting frequently asked questions and guidelines out to communities wanting to help homeowners? We talk a lot about rental assistance, but there's still a lot of homeowners in need and help. And that's why we included $10 billion in assistance. So Secretary, can you talk a little bit about that as well?
Well, we're committed to getting this money into the hands of homeowners at risk of foreclosure and falling behind on their payments as soon as possible. We're working hard on it. We're conducting outreach to state housing agencies to understand their needs and to make sure these funds are quickly and effectively distributed to communities in need. We're working hard at it. I can't give you a definite date when we'll get the FAQs out.
Thank you. And so then the same question to you. As you know, we have also talked about this. The hospitality and leisure industry has been so hard hit. The money that we fought for, particularly in this last package, was really to focus on that industry, not only those businesses that are directly involved, but those that are indirectly involved. And I'm looking to you to help us to make sure that the guidelines get out as quickly as possible where they're needed to make sure we get this money into the communities. And I know this is a focus of yours as well, Secretary Yellen.
Yes, I think, the money that was designated by Congress for restaurants and associated industries, that's being managed by the SBA rather than Treasury, but we stand ready to work with them to be helpful.
Yes, and thank you. And I cannot stress enough the money that we fought for, the $350 billion to our states and local governments.
Sure, absolutely.
The same thing. I mean, this is literally life-saving, and that's why I think that the entire Democrats have fought for this and will continue to fight for this. It's the only reason that this is in the bill. And
Right.
I just can't stress that enough.
Oh,
because
well,
everybody is struggling, and from those states that are, whether they're Republican or Democrat states, whatever you want to call them, states are struggling, and it's in a bipartisan way. And so that's why this was so important.
that help is going to get out very rapidly. We have a maximum of 60 days to work through all of the thorny questions. We're working very hard on it, and we're going to get that money into the hands of state and local governments to use to support their communities.
Thank you. Thank you both so much for what you're doing.
Cortez Masto. Senator Kramer is recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you, Madam Secretary and Chairman Powell, for being here. First of all, I want to associate myself with the comments of Senator Kennedy, specifically about the importance of the independence, Mr. Chairman. I know you and I have talked about this in the past, and it's just really critical. And I applaud you for your discipline in that. What I wanted to talk about today a little bit is that the banking agencies, of course, are starting to roll back last year's regulatory measures that responded to pandemic stresses. And as you know, we made some temporary, provided some temporary relief. And we're hearing now that community banks are under leverage ratio stress because of the influx of deposits, which of course they're holding largely at very low risk in very low risk assets. And of course, somewhat because of their strong commitment to the PPP lending. So as the banks continue to work with their customers and communities, I'm just wondering, what factors will you consider in deciding how to address leverage ratio pressures, and how much lead time will the banks and their customers get to adapt to these ad hoc decisions? And yeah, I can start with either one of you can start. Maybe start with you, Mr. Chairman.
Right. So on the community bank leverage ratio, that's something we'll be watching carefully, and we'll communicate it well ahead of time. And we're well aware of those stresses.
Very good. Well, thanks. Well, Secretary Yellen, then I'm going to ask you another question, and if you want to address the CBLR as well, that'd be great. But you've made, of course, addressing climate change one of the central points of your time at Treasury. It's been reported that President Biden's climate czar, John Kerry, has encouraged banks and other investment institutions to form a net zero banking alliance. He's also urged banks to provide as much support for alternative energy projects as possible, which seems to be at the expense of more traditional energy projects, and possibly even forcing financial institutions to put political and social considerations ahead of sound business practices. And that would, of course, be a violation of their fiduciary responsibilities to their shareholders. So in light of this weak unemployment numbers, do you think it's a good idea for private businesses to be forced by a government official, or even encouraged by one, to make decisions about where they should or should not put their money, jeopardizing jobs in our energy and other sectors of the economy that are, legal commerce, represent legal commerce and industries and businesses?
Well, Senator Kerry, I think the world faces a profound crisis in connection with climate, and it is appropriate for government, the private sector as well, to focus on how we can mitigate the risks, to encourage banks and financial institutions, lenders more generally, to think about the potential adverse impacts of investments that they may make, and perhaps more importantly, to understand that eventually we are committed to going to net zero emissions by 2050, and that can affect the returns that they receive on investments. I don't think that's inappropriate, but there are no requirements by government that I'm aware of to force anyone to lend for any particular project, or not to lend to businesses that are involved in carbon emitting activities.
Well, there certainly are some very strong suggestions that border on pressure at the very least. And of course, a lot of these bigger banks are responding to that pressure and to market forces as well. But that said, I might just bring up a scenario in, say, a cold place like North Dakota or anywhere in the Midwest for that matter. When we get to times where there's a very like a polar vortex, as some people like to call it, we just call it winter. Or for that matter, you get a peak hot summer stretch when the baseload electricity that people used to rely on to keep their companies running, their manufacturing facilities going, or the gas that used to be the feedstock for a manufacturer becomes fuel for generating electricity. That could have a pretty negative impact on the companies, the manufacturers, the server farms, who suddenly find themselves with rolling blackouts. So I just hope that we can take a whole approach to these things and not try to pick entire categories of industries as we talk about, particularly as we talk about fair access to banking.
Well, I agree. This is a process that will unfold over time, gradually, and we need to take account of those impacts.
Thank you for your consideration. Again, thanks to both of you for being here and for your service. Thank you, Mr. Chairman.
Thank you, Senator Kramer. We just call it winter. Thanks for making Tina and me laugh. I noticed she laughed and I laughed. Moran didn't get it, so he didn't laugh. But Senator Smith is recognized from Minnesota for 5 minutes.
Senator Smith definitely got the joke about that's just winter. So thank you, Senator Kramer. I appreciate it. And I think I'm going to start with Secretary Yellen. It's great to be with both of you, Chair Powell and Secretary Yellen. Thank you again, Secretary Yellen, for another display of grace under pressure as you were getting talked over a minute ago. I appreciated that very much. And speaking of which, I want to just hone in on the issue of women in the workplace. And, you and I have spoken about this, the challenges that women are facing in the workplace right now. COVID has made it so much worse. Women dropping out of the workforce at roughly the same rates as men, but now what's happening is men are returning to the workforce and women are not. In Minnesota, it's an 11% decline in women's participation in the workforce. And one of the there's two basic issues that women face. One is lack of access to affordable childcare, and the other is lack of access to paid family leave. And this is happening in the United States in different ways than it's happening in Europe, as I understand it. So as part of the American Rescue Plan, as you well know, I worked with Senator Warren and others to make a significant investment in shoring up our childcare system.
Yes.
And, Secretary Yellen, I was wondering if you could just talk a bit about this. How does this ability of women to participate in the workforce connect to our economic competitiveness, and what role does childcare play in making sure that women can participate in the workforce and support their families?
Well, I think that women have contributed enormously in the United States and in countries around the world. Their labor force participation has boosted growth and has boosted household incomes. And we saw a surge in women's labor force participation in the 1970s and 80s, but it's leveled off and it's even declined somewhat. And there are a number of reasons for it, but when you look at the fact that in many European countries and other developed countries, labor force participation of women is now higher than it is in the United States, what stands out is paid leave and affordable childcare as two things that distinguish the United States from those countries. They're really critical to enabling women to successfully participate. And I think it's exciting that the American Rescue Plan really addresses these issues, providing additional, very meaningful support on both fronts.
Yeah, thank you. I think what we do in the American Rescue Plan, not only with providing, with shoring up our childcare system, but also the child tax credit, which is going to have the impact of reducing child poverty by half, shows us the policy levers that we have to make our economy work for women. And ultimately that contributes to our economic competitiveness, as you say.
Yes, and it also helps children, I think, in the long run succeed to have that additional support.
Absolutely, absolutely. It addresses that opportunity gap, as I like to talk about it, rather than an achievement gap, because it's really a lack of access to opportunity that our children have if they are living in poverty. This brings me to another thing, Secretary Yellen, I want to talk with you about. It's something that you and I have also talked about. Data shows us that people experiencing homelessness have been disproportionately impacted by COVID. And you and I have spoken about what we can do to get the recovery checks, the stimulus checks to people who are experiencing homelessness, and there's particular challenges getting the checks to them.
Yes.
Recently, your staff provided my office with a briefing on what Treasury is doing to connect with local shelters and providers and continuums of care to get checks to people. And I was really heartened by hearing what you are doing. And I want to make sure that these community-based efforts continue. So we just have a couple seconds, but I was wondering if you could just maybe just talk about that for a minute. And then if you could commit to providing some sort of guidance or publishing best practices, because I think there's some great examples of what works around the country.
Great. I mean, I think publishing best practices, trying to figure out what they are, is a very important role that Treasury can play in this and in other programs that we're charged with implementing. One of the most difficult issues is getting impact payments, and it will also apply to the child tax credit, getting these payments to homeless individuals. And as you say, we are working very, very hard, and happy to work with you to try to do everything we can on that front. We're working with IRS on this as well.
Thank you. Thank you, Mr. Chair.
Thank you, Senator Smith. Senator Moran from Kansas is recognized for 5 minutes.
Mr. Chairman, thank you very much. Chairman Powell, thank you for joining us. Secretary Yellen, pleasure to be with you again. Look forward to being in the circumstance in which it can be different than virtual. Thank you both for your public service. My question will be directed to you, Madam Secretary. The American Rescue Plan included $350 billion for state and local fiscal recovery fund. To be used for emergency funding to distribute to states, counties, local units of government. I know that the department is currently developing guidance in this regard. I'd be interested in knowing the time of that guidance, but I want to highlight for you a circumstance that Kansans and many other states, particularly in the middle of the country, are experiencing. No relief can be for COVID can be taken without looking at its broader consequences. And I'll take us back to what the chairman was talking about winter. A few weeks ago, we had this tremendous cold snap that invaded the country, north to south, from Canada to Texas. And that cold snap created huge increases in utility bills for consumers and even for businesses. It's estimated in Kansas, someplace nearly $100 million in utility increases because of 3 days of temperature below zero and the cost of natural gas. In other words, the purchase price that utility companies were encountering to purchase enough gas to keep homes warm, to keep businesses operating, was so high that the utility bills now reflect that $100 million increase that was experienced over just a few days. A few examples for you, Madam Secretary. There's a Kansas municipality. Some of our communities generate their own electricity and then sell it to their citizens. But one of those cities in Kansas with a population of less than 300 people had a February gas bill 3/5 of the total amount of their annual city budget. Another city, just over 1,000 people, with household incomes less than $30,000, had a February energy bill over $9 million. A school which typically has a $10,000 a month gas bill in the month of February, it was $400,000. A small greenhouse in rural Kansas received a gas bill of just under $100,000, of course, crippling that business with an unexpected expense. And my question to you is, I would love to have a commitment that you would work with me and others. I think there's other senators on the banking committee and certainly other senators who have had experienced the same circumstance. And I would like to see our state and city, our local units of government have the flexibility under the belief that you cannot take the financial condition of COVID in just a vacuum. All the things that pile on when a business is already so fragile, or when utility bills, individuals and families are already struggling to pay their utility bills, we can't take that just in isolation. And Secretary Yellen, I would just ask two things. Want to make sure you're aware of the circumstance, tremendous damage to small businesses and consumers in Kansas and elsewhere. Ask if you also would see that flexibility makes sense to you, on a commitment that you'd work with me to make sure that we can convince you and that you have an understanding of the circumstance, and then an idea of the time frame in which that relief the guidance might be in place so that relief could be used.
Well, Senator, first of all, let me say I appreciate your describing to me the problems that your state and others face because of the cold weather and the impact on utilities.
Should we just go?
Second, I promise that we'll work with you, and our staff can be in contact with yours to discuss the needs that your state has to deal with this problem. There is a good deal of flexibility within the law on how the funds can be used. Over the next 60 days, the statute provides 60 days for payments to get out, and we need within those 60 days to clarify what the funds can be used for and can't be used for, and glad to confer with you about whether or not this is within the realm of what the statute has in mind. So why don't we have our staffs talk offline about this?
Secretary, thank you for your answer. And you and I make a great team. We ended this in just Sherrod Brown's 5 minutes exactly. Thank you for that today and your response. I appreciate your willingness to cooperate and your understanding of the tremendous challenge and burden that individuals are having at home. Thank you. Thank you, Mr. Chairman.
Thank you, Senator Moran. Senator Daines, have you voted already?
I have, yes.
Okay, well, I'm going to call on you, then I'm going to go vote. And
Okay.
And I apologize to the chair and to the secretary. We're going to take this up because there are 2 or 3 more people that want to. So I'm going to go vote, call on you, then we'll recess after your question until about 12:30.
Okay.
So if Secretary Yellen and Chair Powell could stay a little bit longer. So Senator Daines will go for 5 minutes now. We will just recess after your 5 minutes, and then we'll come back about 12:30 for 2 or 3 other senators. Thank you all.
Thanks, Mr. Chairman. Appreciate that. Well, let me start off by saying I want to express my utter shock at the provision that was buried within the recent $1.9 trillion package that prohibits states from directly or indirectly cutting taxes. This provision was snuck into the bill at the very end of a more than 24-hour period of continuous voting. Process aside, this astonishing level of meddling by Congress in state fiscal affairs should be troubling to anyone, a Republican, Democrat, Independent, who believes fundamentally in the concept of federalism. This is why I was very pleased to see your response last night to the letter from 21 attorney generals who expressed concern about this provision, including my own Attorney General in Montana, General Knudsen, confirming that states can in fact still cut their taxes. And to quote from your response, nothing in the act prevents states from enacting a broad variety of tax cuts. That is, the act does not deny states the ability to cut taxes in any manner whatsoever. It simply provides that funding received under the act may not be used to offset a reduction in net tax revenue resulting from certain changes in state law, end quote. I know that Senator Crapo mentioned earlier in this hearing a specific hypothetical scenario involving unemployment insurance trust funds, and you stated the Treasury is still working through some of these issues, and you have 60 days to issue guidance. Right. Great. Thank you.
That's exactly right.
Great. Well, let me just to clarify too, our legislature in Montana, it meets every 2 years. They're meeting right now, and they're slated to adjourn on or about May 1st. Sometimes it bleeds over a couple of days into May. So they really need this guidance as quickly as possible, as they're kind of now in the in the final throes of this this biennial session. Secretary Yellen, then would you commit to issuing guidance well in advance of the 60-day statutory deadline?
I can't commit to that. There are a host of complex questions that have to be resolved, and we need to confer with state and local governments, with members of Congress, and work out thorny legal issues around this. We're working as rapidly as we possibly can to get this guidance out, but I don't want to make a commitment that we can get it out a lot sooner than that. We will get it out just as soon as we possibly can. We want this money to be in the hands of state and local governments, but we'll just do the best we can.
Thank you, Secretary Yellen. Yeah, appreciate it. Just with what's at stake right now with legislators that are meeting on more of a periodic basis. Shifting over here to Chairman Powell, some have proposed that the Federal Reserve change its operating model to include holding retail and commercial deposits through Fed accounts opened on their behalf by banks with over $10 billion in deposits. Where adequate coverage through banks is not achieved, post offices would open accounts for retail and commercial customers with the deposits held at the Fed. These accounts would be offered at no cost to consumer and retail customers. My question, Chairman Powell, is the Federal Reserve equipped to service individual retail and commercial accounts?
No, and of course, we're not permitted under current law, and that's never been our role, and it's really not been the role of other major central banks. It would be a quite dramatic change in our role in the economy, and one that I think should require very careful thought.
Thank you for that thoughtful answer, Chairman Powell. In 2019, the Fed, the OCC, and FDIC took steps mandated by Congress to tailor banks' prudential regulation. We were a year into the COVID-19 crisis, and banks and other lending institutions have been a critical source of relief, have maintained strong capital and liquidity reserves. I think it's crucial we continue to recognize that a bank's size and business model are very relevant to consider when looking at how much risk it poses. My question, Chairman Powell, is do you agree that the tailoring of regulations, including capital and liquidity requirements, to the systemic footprint of a particular banking institution is still appropriate, and that there has not been any demonstrated negative impact to the U.S. economy because of tailoring?
Yes, I would agree with that.
Okay, thank you. I'm out of time. I appreciate the answers of both Secretary Yellen and Chairman Powell. Appreciate it. And I guess, do I need to recess the committee?
Yes, so we are going to be in recess until about 12:30. If Secretary Yellen and Chairman Powell can please remain on the call, feel free to mute yourself and turn off your video until we're ready to come back, or however you feel comfortable.
Okay, so we're in recess until 12:30. Thank you.
Just to be clear, you need us to keep sitting here until 12:30, or can we come back at 12:30 or 12:25?
You can come back.
All right, just making sure.
Yeah, thank you.
of people who have checked in. Senator Warnock, are you here? Senator Lummis? Okay, we're gonna adjourn. Thank you, both of you, for your patience, especially, and thank you for the staff. I know in informal conversations that I'm privileged enough to have with both of you, and I always learn something, and you're always so helpful. I know what incredible staff you have because of the immense workload you have. I think our two witnesses today sent a clear message about fiscal support and the American Rescue Plan and what we need to do. It's clearly the right move for the economy. Getting money into people's pockets is good for workers and their families. So thank you all, and the committee. I'm sorry, one more thing. If senators who submit questions for the record, they have to be in Wednesday the 31st. And Secretary Yellen and Chair Powell, based on a change we made to our committee rules, you have 45 days to respond to any questions if there are any. So thank you, and the hearing is adjourned.
Thank you.
Thank you
both very much.
Thank you so much.
Thank you.
Pleasure.
All right.
Good to be with you.
You
Take
too.
care.
Thanks.
Bye-bye.
Bye-bye.